Nolan, it is very good to see you. I'm glad we have time to talk today because everybody's feeling a little bit stressed. So, we're going to talk through three opportunities, financial planning and investment opportunities in a down market. So, recently, the US stock market saw the biggest 2-day wipeout in history, 6.6 trillion. In fact, the market has lost 11 trillion since inauguration day. And before we get into how to take advantage of all that, I do want to talk through what we're seeing, which is, of course, concentration risk. We've talked about this before, where 80% of the market's movements due to only 10 stocks about. To see that in a different way, this is the S&P's 3-month performance. The Mag 7 alone have lost 2 trillion since the start of the year. So, Nolan, when we see this much red on the board, what do we need to keep in mind?
Well, Erin, thanks for asking. This is a very good place to start because a lot of red usually raises a lot of questions. But important things to keep in mind, usually people who are over allocated into some of the bigger red squares that we see up there, like NVIDIA, Microsoft, Apple, Google. If you're over allocated into those areas, you should be comfortable with volatility like this. Over the past few years, even 2022, when the NASDAQ dropped, 30%. We experience volatility with stocks like this quite frequently. But you mentioned the concentration risk, and that's what we've been kind of steering people away from or cautioning people towards over the past year or two, is the fact that so much of the market's movement is due to so few companies. So what we've been experiencing this year, and most notably with tariffs being introduced and unknown regulation, is it's now affecting one particular or two particular sectors, and the whole market's being driven down because of it. So that's the concentration risk. And when it's good, but when it's bad, it's not so good.
Very painful. All right. So now let's talk through how to take advantage of this down market. Number one, put your cash to work. I feel like a lot of us feel a little bit better when we can stuff all of our cash in the mattress, but that really does compromise our ability to build wealth.
Yeah, and keeping money in cash for too long, we notice that people's purchasing power reduces over time,
Right.
or the money that you can buy things with today doesn't buy as much 1 year from now, even if it's in something like a CD where it's earning 3 or 4%. So putting cash to work, and bad market times are usually good times to do it. You can find particular securities, maybe even stable assets that are essentially on sale because the market's corrected most recently. So look for opportunities over the next month or two as the volatility continues and the market maybe bottoms out at some point. There's probably some good opportunities for putting cash to work.
All right. Next, take advantage of stock losses and consider tax loss harvesting.
Thanks. And this one we've been doing a little bit more frequently over the past month or so since the market's really corrected into March. What you're doing is you're harvesting or selling these assets after they've decreased in value over a short amount of time, so that in future years, or even this year, later this year, when you have investment gains, the losses that you sell right now can offset those gains in the future. Now, this is particularly for taxable accounts, and this tax loss harvesting graphic shows you what you would do in a taxable account, but not an IRA, not a Roth IRA. There are some particular rules around tax loss harvesting, but now's a good opportunity because some of those stocks that we looked at over the past 3 months are down by 30%. It's a pretty significant discount.
And then last, explain why a Roth conversion makes more sense in a negative market.
Yeah, and this one we've done a few of already this spring. What you're looking for with Roth conversions during times like this is converting particular assets that have gone down in value from your IRA over into your Roth, and then allowing them to recover once they're in the Roth IRA. I'll take NVIDIA, for example. It's down maybe between 15 and 25, 30% this year, depending on when you're watching this video. So if you had NVIDIA in your IRA, you then convert some of the shares over into your Roth, pay the tax on that conversion. You're converting the shares once they've gone down in value, and then they can recover in a more tax advantaged account in the Roth IRA. It's a wonderful thing to do. We've done it a couple times this spring, and we'll probably do it a few more times throughout the summer as well.
All right. Well, hey, it's great to hear about silver linings as we all feel just a little bit stressed out again by all that red. But Nolan, I'm glad we were able to talk it through. If somebody wants to talk about these strategies in depth with you, how can they get a hold of you?
So calling us at 616-301-2581 is a great way just to call us, ask questions. You can press option 1 for me, or go to our website, cornerstone-rp.com, and there's a contact us box at the bottom of the page.
Great. Nolan, thank you.